In this week's Market Minutes video, we're going to follow up on some of the things I told you to watch for last week when trying to figure out if the stock market is going to crash. Some of those things have happened. We'll also talk about what to do with the stocks in your portfolio if the weakness gets worse. Plus, I will do my regular weekly market analysis. We'll look at the day trade of the week, and when we do a market scan, I'm going to show you reasons not to take a trade. All of that coming up. So in last week's Market Minutes video, we talked about some of the basic principles to know when a stock or a market is likely to go lower. And some of those things have happened for the overall market. Namely, we're looking for breaks of upward trend lines from falling tops. And like I say, some of those things may have happened this past week. We'll follow up with some charts in just a moment. So how do you know what to do with the individual stocks that you own? Well, I can show you using the chart of Apple as an example of when to sell some of those stocks that you own. And not every stock is in that situation, but certainly some of the high-flying stocks like Apple, Tesla, Nvidia, the high-flying tech names have given some of these signals. So we'll look at that right now. Let's jump into the charts. Here is a chart of the Nasdaq 100. And so what we want to watch for is a break of an upward trend line, step one. And we had that over a week ago. But then also a break from a falling top. Now, a falling top means that the market tries to rally higher and then fails and makes a top that is lower than the previous one. And then when you break that upward trend line from a falling top, you have another stronger sell signal. So we've had that on the Nasdaq 100. Now, some of the other things that I like to look for are where is support? And support is a floor price, and it is established at a point where price stopped going down and started going up. We call that an inflection point low. And you can see that the Nasdaq 100 has an inflection point low around 265 on the ETF. So we're at that support. We are building falling tops, which is a negative. Now, why is falling tops a negative? Well, think about it this way. When the buyers are in control of the market, they're pushing price higher. And then the sellers take over control and they push price down. The buyers try again, but when they try to push price up, they can't push it as high as they had the previous time. So every time you get a falling top, it's an indication that the sellers are stronger and more motivated than the buyers, and that often leads to more weakness. Now let's take a look at another time frame. This is the daily chart, and this was the one that last week had not yet broken the upward trend line. So here's the upward trend line on the daily, and you can see that we're right at it. You could argue that we've actually closed below it, but I'd like to see a little stronger close below. We do have that falling top on the daily, and so if we start to move down through the 269, 268 level, maybe even 266 like we talked about in the last chart, we could start to gather a little more downside momentum. So those support prices are pretty close by. If we start to break them, then get more defensive. Now then the next level of support is there around 250, and then there's one there at 240, and then 230. Anytime we break through one, we should move to the next one. Now what do you do with your individual stocks? Well, let's use the chart of Apple as a way to figure that out. So if you've got a stock in an upward trend, starts to go parabolic perhaps like Apple did. In the case of Apple, it hit a new high and closed below its open. That is a pretty strong signal when you have a parabolic upward trend, one that is curving to the upside. When you have that and you break the parabolic trend, you're likely to get more weakness. So that's one sell signal that we got back on September 2nd. Then you had a break of the linear upward trend line on September 3rd. Then you had the formation of a falling top and the breakdown from a falling top. So that is sell signal number 3. Number 2 was here. Number 1 was there. Now the next one, if you want to be even more conservative and more patient, is if we can start to break down through this floor price that Apple had for some time. And if we start to break down through 110, then you want to even be more concerned about further weakness. Now, what would negate all of this? Well, kind of take the same concepts and reverse them. If the market can break its downward trend line, which is established only in the very short term, the 30-day, 60-minute chart, if it breaks this downward trend line from a rising bottom, so if it made a bottom over here and then broke the downward trend line, well, then that phase of profit taking is almost over. So you're taking the same principles for tops as you do for stocks making bottoms. Now, many of the large cap tech stocks, the Apples, the Nvidias, the Teslas, Microsoft, many of those stocks went up too fast, too high, and they have been breaking those upward trend lines from falling tops. First, it happened on the intraday chart, something like the 30-minute or the 60-minute chart, and now they're starting to possibly happen on the daily interval. So that's even a longer term sell signal. If they happen on the weekly interval, which hasn't happened yet, but if it does, then you've got an even more important longer term sell signal. So if your time horizon for owning a stock is a few weeks, you pay attention to that 60-minute chart. If your time frame is a few months, then you look at the daily chart. If your time frame is a few years, potential hold period, then you should be looking at the weekly chart. And so what you do depends on your time horizon and what's happening on those charts. All right, so let's get into this week's normal market analysis. We'll take a look at the S&P 500 first. And here is the S&P 500, and you can see that we went parabolic. In the short term, we broke, much like the Nasdaq 100 chart. Then we broke down this week from that falling top. We are coming into some support, but it's a little ways down. So I would be fairly careful with stocks right now. Remember, seasonality-wise, the market tends to do poorly in September, sometimes in October, usually bottoming sometime in October, and then rallying from November till May. So that may be the cycle that we're going through right now. Third quarter earnings come out. They're usually the worst quarter, of course, the summer slowdown. And so you get a pullback in the fall, the market bottoms early winter, late fall, and then starts to rally in through the winter and into the spring. That's the typical cycle that we have. All right, so looking at the longer term chart of the S&P 500, you can see that the weekly chart has not yet broken its upward trend line. So we're still okay there, but we did have what I call a bursting bubble candle 2 weeks ago. Maybe we'll bounce off of support this week. Maybe we'll just go sideways for a little while. That would be fine. But I think you need to be very cautious in the near term because there is good potential for some more weakness in the market. Looking at the small cap stocks, the Russell 2000, and you can see that because this market didn't go up as much, it also doesn't have as far to fall. It's got pretty good support here, pretty good support here. So I would say that the small cap stocks don't have as much risk because they didn't go up as much, but they also didn't go up as much, so they haven't really paid you yet. And so it's not really a place to play yet, but it may be where some of that money from the large cap tech stocks flows into. If you get selling in Apple, Microsoft, those kinds of companies, it may flow into some of those smaller cap stocks. No sign of that yet, but just keep an eye on it. All right, moving along to the Canadian markets, and this is a chart of the TSX 60. And you can see that it broke down from a falling top, made another falling top, broke down. So we generally have a downward bias in the short term. Longer term, it doesn't look too bad. We are just tickling that upward trend line on the weekly. But what's important here is that we have the falling top. And so if we break down through this upward trend line from a falling top, then you potentially get more weakness. So I think you got to be cautious with Canadian stocks here because that could happen. Hasn't happened yet, but it could happen. Watch for it next week. Looking at the TSX Venture, which is a lot of mining names, some cannabis stocks, generally in a sideways range. After the gains that it made, that's reasonable. But if we start to break down through the 700 level on the TSX Venture Index, we could see some selling pressure in some of those mining stocks. On to commodities, and gold is an important chart to watch because it has been a place where a lot of money has been made in recent months, but it's starting to show some signs of weakness. Look at this, falling tops. What do we know about that? That's a sign that the sellers are gathering momentum. Now, the upward trend is still intact, but if we break down through this floor price from the falling tops, which is pessimism, and then break that upward trend line, that would be a sell signal for gold. So watch for that. Breakdown through 180 from those falling tops would be a sell signal on gold. Looking at oil, it broke down through support a little over a week ago, and so I would be cautious with oil. It does look more likely to go lower than higher, and we've seen some selling pressure in the energy names. And finally, the fear chart is not really rising as much as I would expect for what the market has been doing in terms of selling pressure. And that may be simply that the market doesn't expect a massive sell-off. It may be that the market investors believe, okay, we've gone up a lot, we're going to take a break, we're maybe going to go sideways. That's what the VIX is telling us. The S&P 500 ETF is telling us we haven't broken down yet, but we could. And I think if we start to break upward trend lines on the daily interval, then you may see the VIX spike. And remember, the VXX is a great way to profit from a sell-off in the market. You also have inverse ETFs like QID, SQQQ for the Nasdaq, SDS for the S&P 500, DOG for the Dow. Those things go up when the markets go down, and that's one way to profit from a selling market. All right, moving along, let us do as we always do, which is get our ratings here. Neutral long-term on US stocks, bearish short-term. Canadian stocks, neutral long-term and bearish short-term. Both right on the edge of going bearish long-term as well. So we have to watch to see if those weekly trend lines get broken. Gold, neutral on both time frames, but I will drop my rating to bearish if we break down through the support that I showed you. And oil is already bearish, negative on both time frames. Stocks are going through some profit taking after the big run up, but this could turn into a stronger correction if we start to see some support get broken. We want to watch for breaks of upward trend lines from falling tops, not only on the indexes, but also on the stocks that you own. Now, gold is starting to test some support, while oil has broken that support and fear is rising. All right, let's now jump over to the day trade of the week. Always a more of an informative lesson on how I approach day trading with my active live service, which is available from Stockscores.com, as well as all of the educational products that we offer. So if you have an interest in that, jump over to the Stockscores.com website. There's lots of videos and information on the site about that. Let's take a look at the day trade of the week. This was a trade on SALM, and it's textbook Tyler trade here. We want to see that action candle out of a situation where nobody cares about the stock. Now remember, this is a 2-minute chart, so it's a day trader chart. The stock, nobody cares, and then you start to see volume coming into it, price jumping. We've got special algorithms that scan the entire US stock market in real time, monitoring 7,000 stocks, looking for this. And when this situation triggers, we basically have a screen that you can watch through the trading day where you can see these real-time action candle alerts coming across. And there's many of them throughout the day. We then qualify them based on pattern, and this one had the right pattern. It is breaking from low volatility. So let's walk through the economics of this trade now. For every $100 of risk, you would buy 2,490 shares. That is $2,540 in capital. Because this stock is under $3, you probably cannot margin it. So it would, again, require a little over $2,500 in capital. It made 6.5 times its risk. So you see 1, 2, 3, 4, 5, 6.5. And that means it was a $650 profit on that $2,540 of capital. That represents a 25% return on a one-day hold. And the market gives us these kind of trades every day, but you need an edge. You need a tool to find them, and that's what Active Live is all about. All right, now I want to jump over to the Stockscores Market Scan tool. And the Market Scan allows us to filter the entire market. And normally I would be looking for stocks to buy. But this week, I'm going to show you a number of charts, and I'm going to tell you why they are not buys, because I think it's also important to know what not to take. So let's jump into the Market Scan now. And like we do most of the time, we run the abnormal break scan. So I'm going to run the abnormal breaks US scan. This particular market scan looks for stocks making abnormal price moves with abnormal volume, and then we assess their chart pattern to see if they have that break from low volatility with some optimism, that sort of thing. All right, so the scanner found us. Oh, something went wrong there. Let me run that again. Run the abnormal breaks US scan. I don't think I allowed it enough time to load. There we go. Run the market scan, and we found 29 stocks. So now we're going to look at, I don't know, we'll look at 10 maybe, and I'll tell you what the problems are with each of these. So let's first look at HJLI. Here you can see the stock making an abnormal price move, but there's not much volume behind it. So that's problem number one. Yes, it was boring sideways trading and it broke out from that, but notice also there's strong resistance over here. So the upside potential is not enough to justify the trade. I like to have at least double the upside potential for the downside potential. This one doesn't have it. No problem. We'll move on to the next one. So AAU, you can see it also had a little bit of abnormal price action on Friday with some abnormal volume, but it's right under resistance, that ceiling price at 80 cents. So that's not good enough. Giga Metals, let's take a look at this. This is a good lesson in many ways because it had exactly what we want to see, but about a month ago, 3 weeks ago, when it was boring sideways trading, it came alive, and then it didn't do much for maybe 2 weeks, and then on Friday it really had a huge jump. So the buying activity that happened back there was caused by investors that have better information than others. They're the ones who caused that breakout from low volatility. When you get that happening, that's a signal to look at taking the trade. This was a great trade setup back then. When the public starts to find out about it, that's when the stock is already well into its upward trend. So I would not buy this here. It went up 185% on Friday. The time to buy it was back there when it first started moving. So it's a hold, but I would not buy it here. SALM, which was our day trade of the week, it looks okay as a longer term trade, but there is issues. There's a lot of investors that own this stock at higher prices. And when you've been losing on a trade and the stock starts to come up to the price you paid, what do you want to do? You probably want to sell it and break even. And that's why stocks that are moving up into prices where other people own it in the recent past usually get stuck because there's lots of supply of stock, lots of selling pressure. So that lowers the probability that this trade can work. And that is why I would not take the longer term trade on this one, although as a day trade, it worked quite nicely on Friday. All right, VBLT has resistance up here, not enough upside, so I would pass on that one. MOGO has a couple problems. Number one, no real strong volume, and also no rising bottoms. See how the bottoms are falling? So there's no real optimism yet. There's a decent chance it'll get up to 250, but I don't think that the reward potential justifies the risk, so I would pass. This one, the bus has left the station already. It's well into its upward trend. It was good back here, third week of July, when it started to trade abnormally, broke out through resistance. That was at $1.60. Now the stock's pushing 240. That's almost up 50% already. It's a good hold, but I would not buy it. And that's the process. You just know what to look for. Those are the things I teach in the active trader course and in the investor course, depending on what style of trading you want to do. Here's CX, not breaking from low volatility. It's been trending higher for 3 months, so it's too late. It's a good hold. SACH is rallying into resistance, probably get stuck there. It's just simple principles that I can teach you in a few hours. That's all done online with the active trader course. And if you have an interest in that, just go to the Stockscores website and learn more about it. And of course, while you're thinking about helping us out, please click on the subscribe button, hit the notifications bell, make sure you like the video, leave a comment, tell your friends, tell your enemies, tell anybody, and get them to watch my weekly video. I want to thank you all for joining me this week. Have a great week in the market and trade well.